Good afternoon, and welcome to Farm Focus for Wednesday, December 26th. Grain prices were hit hard today with favorable South American weather and fund liquidation applying the pressure to the grain markets. March corn futures finished 11 cents lower at $6.93. New crop December corn down 8 cents at $5.99. January soybeans down 15 cents at $14.25. New crop November beans down a dime at $13 even. Kansas City March wheat down 20 cents at $8.25. Minneapolis March wheat down 12 cents, finishing at $8.69. Outside markets were actually a little bit supportive today for the most part, despite the lower grain prices. Crude oil up $2.37 a barrel at this time, trading at $90.98 a barrel. The ethanol market down 2 cents per gallon, following corn lower and currently trading at $2.21. The gold market up $1 to $2 per ounce at $1,660. The U.S. dollar index down 7 points at 79.68. And the stock market relatively quiet, trading just a little bit lower at this point, with the Dow down 11 points at 13,128. Livestock markets were mixed today, with February cattle up 53 cents at 133.75. January feeder cattle up 80 cents at 152.30. And the February hog market down 33 cents, trading at 87.23. Taking a look at news items affecting the grain markets today, the grains did open higher at 9:30, which was a later open due to the Christmas holiday, and they opened higher on follow through to the stronger prices seen last Friday and then again on Monday. But prices for all the grains did turn around, trade lower, and finish near the daily lows. The funds quickly sold the higher opening and kept selling throughout the day. The inability of grain prices to hold on to the early morning rally and then turning lower on the day triggered the funds into another round of aggressive selling. Corn did not take out the lows posted last Thursday, but it was the lowest close in March corn futures since July 3rd. Also seen as just a little bit negative is the fact that some additional rain and snow fell in the southeastern portions of the hard red winter wheat belt, putting some pressure on wheat prices as well in today's trade. If we take a look at the map that shows the past 3 days of observed precipitation, we can see that southeastern Oklahoma as well as northeastern Texas did get a little bit of a shot of moisture, rain and snow combination, but only light precipitation in most of the hard red winter wheat belt from this storm system. Now, if we take a look at precipitation over the last 7 days, we add the winter storm system that moved through Nebraska, northern Missouri, and Iowa. That system provided a little bit of moisture for the hard red winter wheat belt. Then, as we mentioned, the system that just came through over the weekend. So there is some precipitation falling in parts of the hard red winter wheat belt. By no means is it drought breakers, but this is a pattern that we've seen over the last 2 to going on now 3 weeks, is that we have had at least some moisture falling in the belt, where it seemed like for about a month from early November through early December, we had virtually no precipitation. So the marketplace looking at some of this moisture as maybe being an indication that the pattern is somewhat turning a little wetter. In other grain news, we've discussed a fundamental battle in the grain markets over the last month or so. That battle is between tight corn and soybean stocks, which is a bullish factor, battling against favorable South American weather that is a bearish factor. This battle has been going on for quite some time. So far this year, South American weather has been mostly favorable, and that is what has been holding back any significant rally in the grain markets, even though stocks of corn and beans couldn't both be near record tight levels. The funds are holding on to long positions in both corn and soybeans. The favorable South American weather removes at least one possible fundamental reason for the funds to continue holding on to their long positions. Now, that doesn't mean that this weather in South America couldn't change and change very quickly, but at least for now, soil moisture is mostly favorable, and the weather forecast looking ahead is also mostly favorable. Therefore, funds getting somewhat nervous as the potential for a major South American problem seems to be gradually being diminished from week to week. Overall, the weather in South America isn't perfect, but it is good enough that trendline yields can still be expected and record production is still possible. Our weekly export inspection report, which typically comes out on Monday, was delayed due to the Christmas holiday and came out earlier this morning. We take a look at the weekly export inspections for corn, down a little bit from last week, and maintain the trend of well below the needed level for export inspections. You can see today's inspections came in at 13.475 million bushels, only about half of the 24.4 million bushels that's needed weekly to reach USDA's annual forecast. The disappointing exports for U.S. corn is one of the primary reasons why the corn market has struggled over the last few weeks. Turning to soybean export inspections, we bounced a little bit this week up to 44.5 million bushels above last year, which is seen in the purple line, and also nearly triple the 16.4 million bushels that's needed weekly to reach USDA's annual forecast. The trend for U.S. soybean exports over the last few weeks is trending lower seasonally, but we're still running way ahead of the level needed to reach USDA's annual forecast. This is the bullish portion of the fundamental battle, while favorable South American weather is the bearish fundamental. Turning to our wheat export inspections, down just a little bit from last week. This week's number coming in at 15.1 million bushels, well below the 22.316 million that's needed weekly to reach USDA's annual forecast. But what we want to note is, first of all, we typically have a seasonal increase in exports in the Jan, Feb, March, and into April timeframe. And even though exports are still running well below what's needed to reach USDA's forecast, we can see a general trend of improving export numbers. We expect that trend to continue, and we believe that we will see in the Jan, Feb, March, and into April timeframe, we think we'll see a number of weeks that will come in well above the level needed to reach USDA's annual forecast. U.S. wheat prices still one of the cheapest sources of wheat around the world, and that should contribute to stronger export sales and shipments as we move further into the winter. A couple items that we've mentioned are bearish in the marketplace, the very disappointing corn exports, and also the mostly favorable South American weather. But I want to really focus on some chart action today as well, as the charts also one of the bearish factors, not a fundamental factor, but a bearish factor is the overall chart pattern that we're seeing here over the last few weeks. Beginning with March corn, we can see that we had a sideways range that was in place for about 3 months through September, October, and November. But now during the month of December, we broke below that chart support, confirming that at least the trend at this time is still pointed lower. In addition to the charts pointed lower, also we have the moving averages, which are also lined up and pointed lower as well. The 40-day, the 20-day, and the 10-day are also all pointed lower. Those should create some overhead resistance on rallies, as the trend following and chart-based traders will be looking at rallies as an opportunity to make sales, given the fact that the current trend in corn is down. Overhead resistance on the charts comes in around 714 initially, and then more major overhead resistance coming in where our downward trending line and our moving averages come into play around the 725 to 735 level. This is an area which is likely to provide some fairly significant overhead resistance if the market can bounce towards that level heading into the January crop report over the next couple of weeks. Chart support at this time comes in at 687. That was the lows that were posted last week on Thursday. We closed about 6 cents above that level in today's trade. Turning to our January soybean chart, beans did close lower today after trading higher early this morning. So like corn, it was somewhat of a disappointing day in the beans. Now, one difference between soybeans and corn is the fact that beans are still holding their long-term uptrend support. Right now, that support comes in the low $14 range. And unless we break that, we're still in a long-term uptrend. But more recently, the intermediate-term trend has turned lower. So based on the long-term uptrend and the intermediate-term downtrend, we are developing a pennant formation. The market will be forced to break out of this range at some point over the next few weeks. Currently, we have overhead chart resistance at about 1460, where our moving averages come into play, and more major overhead resistance around 1480 on the charts, and at this time, chart support coming in right around 1410 to 1415. This is the range that the market is likely to remain within here in the short term. Turning to our March Kansas City wheat chart, wheat prices, like corn, moving to new lows for the move today, confirming the downtrend that's been in place since the highs were posted at 963 back in early November. Now, the technical indicators are extremely oversold, pegged nearly at zero, and so a bounce from these levels should be expected sometime over the next couple of weeks, likely coming in prior to the January crop report. But overhead resistance is going to come in around 885, which was our breakout level to the downside. Also, around that 885 level is where we've got the downtrending line and some of our moving averages coming into play. So this is an area that is likely to provide fairly stiff overhead resistance on any bullish move here over the next couple of weeks. This is Dan Cowger for Heartland Farm Partners. Thanks for joining us, and have a good afternoon.